From an asset allocation perspective, we've seen bonds get more attractive relative to equities than we've seen at any point in the last decade. If you'll recall from our fourth quarter 2021 quarterly edge, we walked through a metric called the equity risk premium, which essentially describes the relative attractiveness of stocks and bonds. All it's telling you is if or not an investor is being fairly compensated for taking additional risk in equities. This is calculated by using the S&P 500 index's earnings yield and subtracting the 10-year treasury, or the risk-free rate. The earnings yield is essentially describing what an investor receives from a profitability perspective, and so if it is not outpacing the risk-free rate, stocks become less attractive. What we've seen from a trend perspective throughout 2022 and as we look towards 2023 is that in 2022, the earnings yield held up and slightly increased, but that was mostly due to declining equity prices, while the 10-year treasury, that risk-free rate, increased over 40% throughout the year. So that's really what's driven the equity risk premium back down to very close to what is a 30-year average level. And so while we're not in negative territory yet, the fact that we've gotten to a point that we haven't seen since before the financial crisis, it bears attending to. And so as we look towards allocations within the fixed income space in 2023, we do think there are some areas that warrant caution, just given mounting economic pressure and likely a peak in credit quality. But we're more optimistic on the space now than we've been at any point in the last decade.